Hey, it's Cody from Prosperity Finance. I hope you're doing well. Now, I just realized I haven't talked about interest rate for a long time because I've been busy with keeping you up to date in terms of bank policy and what you do under COVID in order to get funding from the banks. But I thought, now it's the time to talk about interest rates. Especially recently, I got some inquiry from clients saying, I got contradictory message. One side, someone saying, interest rate will go down. The other said, the housing market is overheated, so maybe the interest rate can go up. What should I do? So let's talk about today. So firstly, let's talk about what is the current interest rate market. Now, at the moment, the 1 year is the lowest fixed term. Now, the 6 months is quite expensive. It's sitting above 3%. It's only just slightly lower than the floating rates. So I probably wouldn't go for 6 months unless you plan to sell your property soon. Now, the second lowest rates will be 18 months. Depends which bank you bank with, but you would expect just 5 basis points higher than the 1 year rates. So it's also a good option, especially if you want more certainty as well. Not just only, the cost of borrowing, but also have a bit of certainty. So 18 months also a good option. Now, the reason 1 year is the most popular at the moment is because, one, it is the lowest at the moment. So why not take advantage of that? Now, the second reason is lots of people predict that interest rate will fall further. I certainly believe that myself. Now, I have evidence to back up. Firstly, banks are busy with preparing for the negative interest rate environments. Now, New Zealand Bank never have experienced that before. If that happened next year, they need to, get everything ready, the policy process, system ready. So I know they're busy working on that. Well, at the moment, some banking economists saying it may not go to negative because New Zealand economy is recovering really well. So it may not, need to have a negative. But interest rates, the OCR, is still trending downwards, so it's more likely to be a cut, but not as bad as negative interest rates. Now, the second initiative is by Reserve Banks. So they are working on something called FLP. If you haven't heard about it, it stands for Funding for Lending Program. It's a new tool from Reserve Bank. So basically, they lend directly to the banks at much lower rates so that the banks can pass on that cheaper rates to us so we can have a cheaper rates. Now, compare with just using OCR to lower the rates, FLP doesn't affect the deposit interest rate, so the banks don't have to worry about the dilemma of losing the deposits because they need a deposit as part of their funding to lend to us. So if it's interest rate for the deposit too low, then they may not have enough money to lend it to us. So FLP is just another way to incent banks to lend at lower rates. So based on these activities that Reserve Banks and banks are working on, I believe the interest rate will, fall further. Now, the interesting thing is I heard from a customer this week that he said, I saw the news that the Labour government are pushing Reserve Bank to do something, think about the ways to cool down the overheated housing market. Would the interest rate go up? Because, they can do that. Yes, the interest rate can influence the housing market, but remember, interest rate is not just for housing market, but also have other purposes. For example, controls the inflation rate to be within the target range. And also, it's for encourage people spending, help the economy to recover. So they wouldn't just do it for cool down the housing market. Now, on the other hand, I read an article from Tony Alexander, who is the ex-chief economist at BNZ. In his article, he said the Reserve Bank may use two tools to control the housing market. Number one is the LVR. restriction. Now, we all know as the Reserve Bank set LVR restriction for banks until May this year, they remove the LVR for 12 months. But now they confirmed that the LVR would return by 1st of March. And in fact, the bank has already started this process. They already put an LVR restriction of 70% on investment property loan now. So even before Reserve Bank put the LVR rule back. So LVR certainly can help cool down the housing market. And in fact, Tony said it could, the LVR could as low as 60%. So before May this year, it was 70, and now he predict it could reduce as much as 60%. So it put a much bigger hurdle for people borrowing for investment property. Now, the second tool is debt to income ratio. Now, a few years ago, Reserve Bank actually trying to introduce this tool and request the government at the time was National Party asked for approval, but unfortunately it didn't go ahead. Now they're trying to kind of reintroduce that debt to income ratio. So what it does is they work out your total income a year and then they put a limit on the total debt you can have. For example, if you earn 100K and the debt to income ratio is 6 times, that means the total borrowing would be only 600K. So that kind of just high level how that works. Now, potentially they can use that. And in fact, again, bank already start using. Now, this year, when ASB allow 80% LVR for investment property loan, they also put another restriction, which is like debt to income ratio to be 6 times, so that if people don't pass that debt to income ratio, you can borrow despite they lend on 80%. And BNZ has a similar restriction, similar to the debt to income ratio. So these two tools could have big impact on housing market in New Zealand to reduce the increase speed. October, I think based on stats, is growing by 3%, which is crazy, right? So they may not use the interest rates to cool down, but they have other tools. So overall, I believe interest rate will continue going down. So unless you worry about the repayments, worry about the interest rate going up, the 1-year rate is good enough. But if you worry about your job security, you worry about the cash flow, maybe because you have a newborn soon and yourself or the other half is going to stay home for a little while to look after the little one, or maybe you start a business soon. These are situations that potentially your income would be temporarily reduced, but the outgoing is going up. So in that case, it's best to split your loans so that they come off fixed term at different times and leave room for you to make adjustment. Okay, so that's all from me today about the interest rate update. If you have any specific question about your own situation, you're welcome to get in touch with us and I'll help you to work out your own plan. All right, I will see you next time. Bye for now.